This WISE review will continue our look at the content area of investing, and this will focus on the types of investments. Some very safe investments you can put your money into are out there. First, there are certificates of deposit that you can get at your bank. Here, you basically put a lump sum of money in your bank with the certificate of deposit. You wait a specified period of time that you agree to, and then at the end of that time, you get your money back plus interest. Very safe, very simple. Savings bonds issued by the U.S. government are also available. You actually buy these at half the face value of the bond. And what happens is the value of that bond grows over the life of that bond until it reaches its full face value. This is referred to as a zero coupon bond. Some more risky type investments are more of these bonds. Now, a bond is simply a loan. You're loaning whoever you're buying the bond from money, and they're going to pay you that back in the future with some interest. You can loan money to the federal government. They borrow money by selling off treasury bills, treasury notes, treasury bonds. These are considered risk-free because you don't have to worry about not getting paid. They're guaranteed by the full faith and confidence in the U.S. government. States, cities, and counties sell what are called municipal bonds. These are attractive to investors because the interest that you receive, the earnings that you receive, are tax-free, and they're relatively low risk. You basically just have to worry about, will that city or county or state go bankrupt and not be able to pay on their bond. Corporate bonds are when corporations are trying to raise money, maybe to build a factory, expand operations, whatever it might be, and they will pay you interest. That interest, though, will be taxable. And these are relatively high risk because now you got to worry about, will that corporation go bankrupt and not pay you out on their bond? And that's one of the main risks on some of these is what's called default risk. Will they not be able to pay? The other risk you run with bonds is what's called interest rate risk, meaning you lock into a bond that's paying a certain interest rate, and then interest rates on bonds go up, but your money's locked away in one of these bonds that's not paying as high of interest rates. So you're missing out on potentially a higher rate of interest. On a bond, you're going to have several things. First off, the amount that the company is borrowing from you on that bond. That's called the principal. It's also referred to as the par value or face value. It'll have an interest rate that they're guaranteed they're going to pay you on that par value. It's also referred to as the coupon. There'll be a maturity date set on it, which is when the full amount, full face value of that bond will be due to be paid back to whoever holds the bond at that point in time. Stock is another way that you can invest. What you're actually doing is buying parts of a company. You're buying shares in a company. There's several types of stock that are out there. The most common is what's called common stock. And this is what people buy, intending to buy it at a low price and then sell it at a high price. There's another type of stock that some companies issue. It's called preferred stock. The preferred stock actually pays a set dividend, and you have that guaranteed dividend that you're going to get paid. So it's more of an income producer, and you're not really trying to buy low and sell high on that. You're just trying to receive those dividends as you hold that stock. Now, when you're looking at a stock quote, you're going to see several things. First, you'll see what it's currently selling for. You'll also see what its previous close price was. This is because stock prices are tracked by what they are selling for at the end of the trading day for any given day. You'll also see what it opened at that day, and you're also going to see how that stock is performing that day based on to its previous close price. Is it selling for more or is it selling for less? You'll also see the trading volume, the number of shares that have been bought and sold of that stock that day. You'll also probably see if they've paid a dividend in recent history. Remember, that dividend is basically just a share of profits they're going to pay per share to every stockholder for every share of stock that they own. You'll also be able to take a look at a stock chart to see what's been happening with the price visually, so you can see what the ups and downs of that stock's price have been over time. Now, where can you get stock? Well, occasionally you can buy directly from the company. That is called the primary market. More often, though, what you're doing is you're going through a broker to buy somebody else's shares that have already been out there and they have bought. That is known as the secondary market. On the secondary market, you buy and sell shares of stock through stock brokers. And these stock brokers actually buy and sell those shares on your behalf on one of several stock exchanges. The most commonly known ones in the United States are the New York Stock Exchange and the NASDAQ. How do you know what's going on in the stock market? Well, several financial service companies have come up with what are called indexes. What an index is simply a number that is spit out by a formula. The formula inputs the stock price of a selected number of stocks that are specific stocks that they have that are part of that index. And the thought is that that index will mirror what's going on with the market overall as far as the stock market. Some of the common ones out there are the Dow Jones Industrial Average, which actually has just 30 stocks on it. You have the Standard & Poor 500 Index, which actually looks at 500 stocks. And you have the Russell 2000, which has 2,000 stocks in it. And these are just three of the more common ones. There are quite a few indexes out there. So what happens in the market? Well, sometimes you'll hear the term bear market. That just simply refers to when stock prices in general are either level or going down. This is as opposed to a bull market where the stock prices in general are going up. To try to avoid losing a lot of money, you probably want to diversify. Maybe you find a good investment that you see and you say, you know what, I'm going to put all my money in that. Well, guess what? If that investment doesn't perform well, you lose all of it. So that's probably a bad idea. Instead of just investing in that one company, you probably want to invest in a bunch of companies. And rather than throwing all your money in one, you want to put a little bit in each. That way, if one of those stocks or investments does not perform as well as you want, because it might be a bond also, hopefully the other investments that you have will outperform that one and will offset whatever type of loss you might have there. And you can be buying stocks, you can be buying bonds. The whole key concept here is don't put all your eggs in one basket. Spread out your money so that you're not significantly impacted by a less than optimal performance in one of your investments. One of the best ways that you can do that, and the most common way that people do that, is by investing in mutual funds. And a mutual fund is simply where a company has put together a whole bunch of stocks, bonds, or some combination, and you can now buy into that fund. They will have established some kind of investment objective, and then they're going to buy a bunch of stocks or bonds or both that will help them pursue that investment objective. They usually diversify it real well, spreading out amongst a wide variety of those investments that are pursuing that investment objective. And the way that they get paid, the fund managers make their money by taking a percentage off of the amount of the mutual fund, the overall asset value of it every year, and that's called the expense ratio. The better the fund does, the more they get paid, so that's their incentive to have the fund do well. What's nice, though, is that there tends to be less volatility in the price of that mutual fund going up or down, so you can smooth out some of the roller coaster ups and downs that you might see for an individual investment. The last thing that we're going to discuss is something called dollar cost averaging. This is the technique of just continuing to invest the same amount of money regardless of what's going on in the market. Because sometimes you buy high, sometimes you buy low, but it turns out that overall your investment tends to do a whole lot better and you tend to have a lower average share price of what you paid than if you try to time your purchases with what's going on in the market. The key is just keep on investing same amount or whatever regardless of what's going on in the market. That concludes this review.